Good afternoon to everyone. Thank you for attending this webinar, First CECL Lessons Learned for Community Banks, Halfway to CECL Compliance, talking about creating your bank's plan for CECL starting next year. My name is Peter Chirpak from Ardmore Banking Advisors, and it's my pleasure to talk to you this afternoon a little while about what we're learning. It's 2023. It seems like a long way away, and I know a lot of community banks are concerned that they don't want to get started too soon and invest a lot of resources, and others are concerned that they're not getting started fast enough. So we give you some tips on what to do now, what the expectations of the regulators now. What are the best practices that are evolving for smaller institutions? And finally, what does Ardmore and CSI offer to smaller institutions to help them down this journey? Because we do have a solution path for you. That's what we're going to go through today. Just really quick, Ardmore Banking Advisors, if you're not familiar with us, we've been now 28 years advising community banks on credit risk management issues and processes, doing outsourced loan review, as well as acting as a thought leader on community bank CECL, stress testing, and credit data management. We've been partners with CSI for more than 7 years now, and hopefully you saw me speak at the conference if you went this year, or saw us at the Marketplace Forum. Argus Information Systems is a compliance company that has been making bank compliance software for over 20 years, headquartered in White Plains, New York. They offer and do the hosting on the CECL solutions that we have, and Ardmore is the one who actually does the implementation. All of our solutions that we talk about are tied directly to CSI, since we are the only authorized CSI partner for CECL. So that's it for the ad. Let's get into this. Just real quick, talking about what CECL is again, in case you forgot. It's not a law. It's not even a regulation. It's a accounting rule, and it was created by the Financial Accounting Standards Board, commonly known as FASB. And the objectives of the rule were, first of all, to be able to be more forward-looking with the reserves. The current way reserves are managed is that they are based on historical performance for a period of time in the look-back period. And what was during the last downturn, it was determined that we were under-reserved going in and over-reserved going out. And then the idea here would be that you'd be able to add reserves if you think that things are going to get worse, and you'd be able to release reserves if you think things are getting better, something you can't do today. Also, there is an objective to have the ALLL calculation, which will now be called the ACL, to be more transparent to investors, so that investors can look at the ALLL workbook or the ACL CECL calculation and understand risk in the portfolio more clearly. It also was created to create countercyclicality, meaning that when things are going good, you don't have to keep releasing reserves if you think the future is going to be bad. So, and there is some controversy in the press and in some of the industry groups, like the American Bankers Association, who do not think it's necessarily countercyclical, but that was one of the objectives. So the techniques we have to use for CECL, including looking at the risk profile and concentrations within the portfolio in a more direct manner than we do today under the current method. You have to establish that life of loan by your asset class, and what is the history that you consider a life of loan, and what is that calculation? And then you have to be able to create a life of loan loss rate by asset class using various models that you can employ that are approved to create that life of loan loss rate by pool. And then you have to add a future projection. So not unlike Q factors today, you have to be able to adjust for what is not in the model. We'll talk about that a little bit more later. And you have to apply that rate at origination. So at origination is when you'll see the loss rate being employed as you add loans to the portfolio. And finally, a CECL technique is what we call the quantification of qualitative factors, meaning that there's an expectation that if you do have qualitative factors, which is what's expected, that those factors will have quantitative backing or justification. So in a nutshell, that's what CECL concepts are all about. It is a collaborative process, and when you get into it, at Ardmore and Argus, we have several CECL clients, and some of which are 2020 banks. It's not just the bank, and it's not just the vendor. I think one of the worst things a bank could do is assume that they can bring in a vendor who will just take care of everything. The reality is, and it's been underlined repeatedly by FASB and the regulators who enforce it, is that the risk is the bank's risk, and the ALLL calculation is the bank's calculation. So if you look at this wheel, you've got third-party expert advisors suggesting in the upper left corner, this is the role that Ardmore typically plays, where we try to explain to you your options and help you understand what decisions you have to make and what the options are for CECL. Bottom left, the third-party software providers, Argus in this case, providing software that does the modeling and the heavy lifting and managing the data and doing the calculation. Bottom right is your external audit advice on decisions and controls. And the upper right corner, of course, is your bank's CECL leadership, who owns the process. The other fifth party in all this, of course, are the regulators, who really are applying oversight on how all this is being done, and as well as controlling to some degree the capital impact. And as you may know, they extended the ability to a bank to smooth the difference between their current ALLL and CECL ACL over a 3-year period. That's really what they can control. They also recently came out with an FASB rule on how they're going to enforce CECL. If you're interested in that, I can share it with you, or you can go onto the FASB website. So, what should you be doing for next year? CECL compliance is a few years away. What's very clear from the regulators is they want you to start with a plan. That you really need to have a plan for CECL and what your bank's going to do. So if you haven't started planning, let me give you some suggestions. CECL is something that requires a plan because it is a new process. It is similar to the current ALLL, but it's new. It impacts a lot of different areas in the bank. So you're impacting not just finance and credit, but also operations and audit and the executive teams. So there are a lot of people involved. And there is interdependencies between them, in that some departments are waiting for other departments. So you add that to the fact that it's a long, multi-year process, and the regulators expect you to do planning. If you add this together, then it makes a lot of sense to put some rigor around this and have a formal plan. Documentation of decision-making and rationale is key to successful CECL implementation. So when you decide what you're going to do, when you make key decisions, there's an expectation that you'll have documentation on that whole thing. So having a plan gives you sort of a framework to work with there. So some key project planning components, you can kind of start where you are, October 2019, and look at where you want to end up for CECL compliance in March 2023, and kind of lay out how you get from here to there. There's some major milestones that you can consider, which I'm going to suggest a few for you. You can then start kind of plunking those into a timeline and consider that some things will take a lot longer than others. You can assign owners. They can be individuals, they can be departments. If your institution is small enough, it may be just a couple of people. And figure out what the critical path is. There are, certainly some more important things than others you have to decide. And then you can sort of flesh out more detail as you get closer to it. Regulators are not going to expect you to have a completely fleshed out project plan, right from the start, and document everything all the way through the process. So what are some milestones to consider? Obviously, you have to be concerned about resources as you go into any project. What is it that you need to get done, and who's going to do it? You're going to need some help. Most banks establish a CECL committee even if some people are only there to be kept up to date as to what's going on. Others are key players in the process. Certainly data and remediation is what most banks are doing now, most 2023 banks. I can tell you a little more detail about that as we've learned from actually working with community bank data. You have to be concerned about your portfolio history, and you have to be concerned about loss and recovery data, historical. And within that portfolio history, you also have to be concerned about having detail around credit risk concentrations. You have to decide what you're going to do about your pools. We'll talk about that in a little more detail. Do you want to buy or build a model? Do you need to? Can you have a budget for it? Do you have people or resources to do it for you internally? And then you've got to decide about your life of loan calculation and your projection methodologies. What are you going to do about the qualitative factors? And then, of course, reporting, documentation, and then parallel or simultaneous runs for a couple of quarters. Excuse me. So if you expect to end up with at milestone 8 in the end of 2022, how do you lay these out across the next couple of years? As we all know now, thanks to the recent announcement in July, there's 2 clear paths for CECL compliance. Public business entities or non-SRCs will be going live in the first quarter of 2020. Everyone else is going to be 2023. And if you're not sure if you're a small reporting company, which is what an SRC is in the SEC definition, check with your external auditors to make sure. It has to do with how much of your, if you're a public company first, and how much of your shares are out in the public, and also your total revenue. So the path is different. Obviously, if you're in 2019 and you're a PBE, you're in parallel runs right now, making decisions and setting things up and looking at the difference of the impact on your capital and your reserves. But if you're a 2023 bank, you're in a different place. And you can see there's some examples of some of the milestones arrayed by time. I have another slide like that for you. So you'll notice is this a 2-step transition? Obviously, best practices have not evolved yet, as the first banks are just starting to come up with the way they're going to do this. And remember, a lot of them are larger banks, and what they do may or may not be relevant to smaller institutions. But there are some community banks out there who are dealing with this, and what they're doing will become public. And so you may start at one place, and then as we get to 2023, start seeing that you have to move to another process. So it might be an initial plan that changes as best practices evolve. Another way to look at a roadmap would be, in this and next year, you focus on the data that you have and what's available and the models that you could use. So, those 2 things, gathering data, testing your data, understanding why you need data and what to use it for, and the CECL models may be enough for 2020. It's a significant effort. I think we're getting more clarity on why you need data and what you use it for, such that you can know what's noise and what's not. We'll talk about that for a couple minutes. So that way in 2021, you can start doing validation of the models, testing with your actual data, considering peer and economic data and Q factors, get all that out of the way so that you can do production setup and really some parallel runs in 2022 into the beginning of 2023. So, there's time if you haven't started, but you really do need to get started with some of these early tasks now. I can tell you that peer and economic data is going to be very important, particularly for smaller institutions, because what we're seeing is that due to the sporadic nature of losses in some of your portfolios over the last, say, 5 to 8 years, there isn't a lot of loss activity to pattern or model after. So peer data is probably the only way you're going to be able to do any kind of meaningful patterning using some of these CECL methodologies and models. and you get to the target in March 2023. And again, there's another slight variation on this. If your fiscal year end is not December 31, you may be eligible to have another couple of quarters without CECL. So you might want to check into that with your auditors as well. Okay, so what are the emerging best practices? I'm going to take a couple of minutes just to give you an update on what's going on and what we're seeing with our banks. So I like to call this the recipe for CECL, because it is a recipe. It's the combination of a number of things. So we've been working with 2020 banks and testing these different impacts. So now we're starting to understand how changing different components of the stew, as it were, gives you different flavors of CECL. And so the key things to consider is, first of all, the data that you have. The data you have is going to impact all your other choices. That's why the regulators, FASB, vendors were all pushing you guys to get data. Now, if you use any of the solutions that Ardmore and Argus do, we will have access to CECL history or core history in CSI going back multiple years. Having history is good, but having good history is much more important. And what I mean by that is, a certain amount of breakout by different codes. Ardmore does a credit data assessment for institutions and for CSI institutions, because we really understand the CSI data structures. So we do that as a standalone thing, but also as part of any of our solutions to look at, do you have the data you need for CECL? What are the key elements? And how will you be hindered or helped by what you have? And maybe here, as we sit in 2019, maybe in 2020, you want to adopt some new data capture processes, some more detailed coding, so you have a few years of really good CECL data. Quantitative models, obviously, we'll talk about those a little bit more, but these are the methodologies that everybody talks about. That's part of the stew. Breaking out your pools if you need to. I can bring you up to date on some testing that we've done there. The life of loan calculations. You have a number of options and choices there as well that you have to decide how you want to do it. You have to include the future projections. How are you going to do them, and what's the best justified way? And then, of course, and the reason that I'm spinning on the Q factors is really I'm not sure how this is going to work exactly. I'll talk about that a little bit more. But, the key is to choose your recipe and make sure you can justify it, that you have documentation behind your rationale and your decisions. You should be good to go. So let's talk about a couple of these ingredients in the CECL stew. The first one, establishing historical periods for calculation. I think people intuitively think that the more data you have, the better. That's pretty true as far as having history. More history you have, the longer periods that you can look at your portfolio's performance is great. But what we're finding out is that there is no specific number of quarters or years of data you should be referring to in your solution. In fact, FASB goes out of its way to suggest that you may not want to use all the history available because it may not be relevant. Let's not forget, one of the goals of CECL is to create a justifiable calculation of potential loss. Basically, what you're saying is, this is what I think, this is what I believe, what management of the bank believes is the collectability of these different assets in the future. And the future really may not be anything like the most recent past. You may say, well, to me, it looks a lot more like 2006 than it does in the future, than it does look like 2019. So why would I want to use 2019 and 2018's history when I really think 2006 and 7 is more reasonable and is more relevant to the future? So that's something you need to think about. And so you may not want to use all of the history available to you. And if you do use all the history, you may find yourself pulling in losses from the previous downturn, which may be considered outliers at this point. And you may say, well, I really don't want to go that far back because I don't want to pick up these losses, which I don't believe are representatives of the future. So it's just one of the moving parts in this calculation. Recovery data is huge. I mentioned this in previous webinars that it can make a big difference, particularly when you're dealing with not that many losses in your history, and any recoveries then will be significant. And it is the net charge-off that we're looking for CECL. So if you're not keeping recovery data in CSI or your core, you may want to start doing that, or at minimum, you want to keep that data in a spreadsheet somewhere so you can bring it into your CECL calculation. Some smaller institutions don't even record the detail of their recovery, so they can't match them back to create net charge-offs. So it's the best practice to do so. We recommend you do. And it makes we've seen running with and without recoveries that it makes a significant difference. Qualitative calculation alternatives. This has been pretty much beaten into the ground, I think. There are a lot of different ways to do it. I would tell you that there's no one endorsed method. All of them have good and bad things about them. You need to understand them all, so at least you can say that you understand them. I would argue that you do not have to try them all, although you should find out somebody who has, and if it's a vendor or a third-party expert or yourselves or a peer, you got to be able to understand them and to talk to auditors and regulators about why you want to use what you want to use and why not. There's no one great way to do it. Sometimes different types of assets perform better with different models. In my view, the biggest challenge you have is if you don't have significant losses in portfolios, you can't come back with a zero. So it's going to vary. There is a weighted average remaining maturity, or WARM method, that has been talked about for smaller banks. That is not considered really risk-based because it doesn't really do anything that suggests that there are changes in payments, that there's an impact to the economy. It's just a straight line, almost like an ALM payout method. And we see returns that are pretty high, at least so far. And some of that has to do with payment information not being kept accurately so that the calculation isn't up to date. But we don't think it's necessarily going to be used by most banks because it's pretty hard to justify. And it's been criticized. There are other methods that are probably not going to be available to a smaller institution to be really valid. PD and LGD, or probability default and loss given default, and discounted cash flows is probably a little beyond what most community banks can do. So we're looking at really the big three, which would be vintage, snapshot, or cohort, which we consider the same thing, and then possibly WARM as what's most likely to be used. And those are the ones that we're testing as well. So one of the first things that we've learned is that you don't have to necessarily change your pools to do CECL properly. What you can do is structure your pools with sub-pools. Now, so it sounds like I'm talking in a circle. What I mean to say is that you don't have to necessarily take your asset pools and break them into separate pools and create separate loss history for all of them. You can keep your pools as they are, but within those pools, break them out into small groups that are more risk-based and fit better with some of these calculations. And these sub-segments then can be basically calculate loss rates for them by themselves. So for example, the example we have here in vintage would be create some sub-pools by term so that you can say, well, here are all my CRE loans in this pool. Here are my less than 5 year, 5 to 7, and 7 to 10. That way you're isolating longer term credits from shorter term, and you can which have different risk characteristics. And that way you're not penalizing the shorter term loans with loss rates that are longer than they need to be. Similarly, with a cohort or snapshot, you can break it into risk groups based on things like risk rating or times delinquent or delinquency status. There are even other things like credit score you could use that, again, isolates different groups from each other to make a more accurate and stable loss rate. Have to be careful when you're doing subpools, though, because if you break it out too finely, then there really isn't anything that you're going to see as far as loss history that you can use to justify a calculation. I mean, if you only have 50 loans in that subpool, you'll see maybe one loss over 5 years. It's not, or 10 years even. It's really not going to be very useful. So you don't want to go too deep into this with a small portfolio, but you want to consider it. But subpooling in general is a great idea, we think. But it's just the best practice that, it helps inform the bank about risk, and that's really what we support. I mean, example of some subpooling would be something like this. Now, these are maybe a larger, maybe $1 billion institution might go into this level of granularity. So you may not have this many subpools. You may have just 2 in each one. Or you may not just have one because it's such a small pool that it makes no sense to break it out. But the advantage of doing it this way, as opposed to creating separate pools for each piece, is that you can use the loss history of the overall pool and just break out the CECL calculations by the subpools. Life of loan calculations, again, seemed pretty obvious when we started talking about this in 2017, which was, life of loan is pretty easy. Just establish the origination date and the maturity date, and and then you basically would average it out across a whole pool, and then you'd have a life of loan. Well, that doesn't turn out to be true. First thing you need to do is actually create a adjusted or discounted, some people call it an actual life of loan, which would be considering prepayments, charge-offs, TDRs. That's it right in the rule, so it's something you need to do. And that way you're getting a much more accurate life of loan, because we know that, for example, 20-year mortgages don't all last 20 years, right? So one way you can do that is do it yourself, is take your closed loans date and compare them to the maturity date and see what's happening. Usually you're going to see the closed loans dates are different, and they're usually shorter than the contractual date. So you can use those dates for your life of loan calculation. One way to do it would be to take the longest loan in any subpool, longest term, and say that's the life of loan. So you could say, in a subpool of 5 to 7, if there's one that lasts 7 years, then the whole life of loan is 7. Or you can do an average. The average life has some advantages, because if you average out all of the actual lives of loans within a subpool, you're going to find it's going to be significantly less, which means you're going to consider less charge-offs. And that means if you have a charge-off that's past the average life, in a number of the calculations, it's actually exempted. So, for example, if you have a 7 to 10 year pool in subpool in your multifamily using a vintage calculation, and the charge-off happens after that period, which the actual period in the 5 to 7 is 6, and you have one that charges off in 6.5, it would not be considered. So the average life really treats those things as outliers and does not include them. On the other hand, with cohort, it does include them, because the cohort or snapshot method looks at all activities within the pool, regardless of origination date. But again, the less periods that you consider, the less you're exposed to losses. So it's possible that by using different methods for life of loan, you could actually sort of quantify your way to a qualitative adjustment and say, I think these are all outliers. We don't want to include them. So we're going to use an average life of loan, which doesn't consider them as active. So this is something you'll have to consider when you get down the journey to looking at your life of loan. So here's an example of a table of a real bank where the average life of loan using contractual life versus the average life of loan using the average life of loan. And you can see there's significant differences, like in cash secured up to 5 years, the total life is 5 years, but the actual average is 2. So that means any charge off if you're using vintage after this year 2 would not be included. And that is considered a legitimate process and method to do. That said, we haven't gotten a lot of input from the audit groups yet on this. The IACPA has come out with what they call a practice guide for CECL audit, and that came out in last month, I believe, and at the IACPA convention. That has got a lot of specifics, and if you read that, you're going to want to just forget about CECL for another 3 years. But that is really written for larger institutions, and it goes into great depth on what you need to do. But if you're curious, and you go to the IACPA website, you can find their CECL guidance and get a sense of what they're concerned about, what the auditors are concerned about. But still, for smaller institutions, we have not gotten a lot of input as to what's expected. And so you could look at what the larger banks are expected to do and assume that it'll trickle down. But how much and how specifically, we don't know. The last thing I wanted to hit on this, before we go into talking about some key decision points and then some solutions, is this whole, I would call it the Q factor craziness, because you've got qualitative versus quantitative quandary. What do you do, and how does CECL affect your Q factors? Well, what I like to look at is this. What is the bottom line of change from CECL? What are we looking at here? Well, the goal is to try to create a best effort and justifiable estimate of the collectability of cash flows on your existing portfolio, as well as new loans at origination. That's the goal. I mean, I think it's pretty clear, pretty understandable. Now, the typical current average ALLL is about 20 or 30% quantitatively calculated based on historical lookbacks. That means that 70 to 80%, and this could be more for some of you, is based on using these regulatory qualitative factors. That's huge. That means that, for example, if you're worried about the impact of CECL, and let's say 25% of your ALLL is calculated using a quantitative calculation, 75% is Q factor. So what does that mean when you do CECL? Do you keep all the Q factors, or under CECL, how much of it is going to be quantitative and how much of it is going to be qualitative? All we know is, for example, the regulators in the IACPA have said that the more complex and comprehensive your models for CECL, the less Q factors you need. And I believe the quote is, you should use qualitative factors under CECL to adjust the quantitative calculation based on the limitations of that calculation. So if you're using a simple basic calculation, you're going to have to do more qualitative factors, all of which are going to have to be scrutinized and justified. If you use a slightly more complex and comprehensive calculation, you'll have less Q factors. So if, for example, today you're adding in a significant amount of reserve for the regulatory qualitative factor on portfolio mix and current economic condition adjustments, you'll find that if you can replace those with a CECL model, that'll be to your advantage. I mean, for example, I'm working with one bank that is currently, and this is I guess $1 billion bank, they're currently putting over $1 million of reserve in for a Q factor on the future, the current economic and future conditions. Under CECL, actually, it would reduce the ACL, because right now, if you use a quantitative model for looking at economic factors, things still look good. So you would actually reduce your ACL using that, as opposed to adding to your ACL, which is what people are doing today. So it's kind of a little mystifying as to how that's going to work and how acceptable that's going to be. Another way you can look at it is, what am I going to do with the calculations? What am I going to adjust quantitatively, or what am I going to instead leave quantitatively and adjust qualitatively? So it is sort of a balancing act. And, the real question is, what do you do? Can you change or even manipulate or adjust your calculations, your quantitative calculations, and bake in effect, Q factors? And what would you do to do that? Well, you could add peer data. You could further break out your subpools. You could adjust for the economic cycle within the calculation. You could even use things like average life of loan, or even pick particular historical periods that you want to use based on what you think is relevant. So that would all be going into the quantitative. Or on the qualitative side, Q factor your way from what you get to what you think is supportable and reasonable. Some of these current conditions, future economic conditions, you could basically take that 25% CECL calculation and just Q your way to a number you feel you can support. But what is reasonable and supportable to your management, to your regulators, to your auditors? Honestly, we don't know. We do not have that. We have a sense. We don't know what the largest banks are thinking, but that's not necessarily what's going to work for you. So bottom line of all of this is you've got some decisions to make coming up. So the more educated you can get on those decisions, what they are, what they mean, how they would affect your portfolio and your capital, the better. And the plan to get there is really what you need right now, is to figure out how to address these. So I've sort of tried to synopsize those into 8 key decision points for your CECL plan. You'll need to have decisions on all 8 of these for you to be able to set up a CECL calculation and run parallel. But you've got time to figure it out, which is the good news. And we've talked about these, but just to recap, what history do you want to use your portfolio as your basis for your quantitative calculations? You want to use 8 years, you want to use 3 years, you want to use the most recent, you want to weight them different ways. You have a lot of options. CECL is a very subjective rule. Your quantitative model, what methodology you're going to use to go back and calculate what kind of loss rate based on your life of loan history. What you want to use, and you have to figure it out by pool. I'll give you an example of how it could be different. We have banks who have residential portfolios that are being originated elsewhere. Those might need to be broken out because of the fact there is no loss history at all because they're new to the bank, as an example. You may need to heavily apply peer history to that because you have no real history within the bank. And that's different than having historically information, but it all comes to zero. I mean, that's a little bit different. That means you have loss history information. It might be very, very low, but you've got it and you can justify it. If it's a whole new product line or a whole new product that's evolved recently, you don't have any losses at all. And you'll need some sort of way to do that. And peer might be that way. And you might want to break those out separately. You may have to use a weighted average remaining maturity model on some of these if you have no other data. And, peer data is also a bit of a mystery. It's pretty clear that the only really good free data you have is the FDIC peer data, but that's not necessarily always going to work for you because it's annualized loss rates by call code, which may or may not be in line with what you do. You're going to have to decide about whether or not you're going to do subpools and how do you break them apart? What's logical? How do you not make them too small? This is where having good data and being able to look at concentrations within these pools is helpful because that'll help you determine what can you break them on, what makes sense, what is a good distribution of losses or the portfolio. Fifth, what is the quantitative method you're going to use, and are you going to use a life of loan calculation that is actual or averaged? And there are different ways. I have here decay and attrition. These are models that look at how loans move between basically migration between risk grades, how long they last, and this is part of how you calculate their life of loan. So you're going to have to decide how you want to do that. Projection periods, we've seen some pretty big impact of doing, if you do a 4-quarter projection, if you move it up to 8 quarters, it's very significant. And which do you want to use and why, and how do you justify it, and what makes for a more volatile ACL. Pool disaggregation, breaking apart pools. What we've seen so far is it doesn't make a lot of sense for most small banks because it's simply splitting apart a pool. It's going to, depending on what methodology you choose and all the other moving parts, it doesn't really seem to make a great deal of sense to break apart a pool based on some pattern that you notice that may or may not be reflective of how your portfolio performs in the future. And gaming the system by simply using the breaking pools apart to get the best possible result is not going to be justification that regulators and auditors want to hear. And finally, the quantitative economic projections. Q factors, that balance that I showed on the previous slide, what do you want to use and how are you going to justify it? So these are key decision points. Now, how are you going to get from where you are today, which is in most cases banks collecting data and trying to get educated, to being in a position to make these decisions all by 2023? What we have for our banks, CSI banks, is the CECL Boot Camp, which has been around for a little while. And it seems to us makes sense more than ever now with the delay that there is no need for you to necessarily go out and buy software in 2020 for something you're not going to use till 2022. However, there are things that you do need to do now, and some of them are data related and some are educational related. You need to build a support process to get you from here to there. So the CECL Boot Camp for this year, the banks who've been participating do get that data assessment service, which is by Ardmore, and with the cooperation of CSI, we help give you gaps from best practice and tell you what you need to do. That's a great starting point for banks who aren't sure what they need to do or if they need to change their data collection or coding. Then we give you a credit data mart if you're a CECL Bootcamp member, meaning that your CSI data starts to build in your own data mart, where you can actually augment that with other things like recoveries. It addresses audit concerns about where your data is and what you're doing with it, and it's in control. And it builds automatically because it's an automatic feed directly from CSI. Other things that come with the boot camp currently is, if you subscribe, is there's a forum with a portal where you can go in, look at things like webinars like this one, white papers, fact sheets, information from FASB, as well as if you wish to ask questions of CECL experts or of each other, there's ways you can make post conversations and questions. And we have ongoing educational webinars like this one for boot camp members. That's what we really offered in 2019. Starting next year, probably around the middle of the year, we're going to add more feature and function to keep you involved with CECL. We're going to add a feature and process where we're going to go through your loss and recovery history for completeness and quality and try to help you identify what key historical periods will make sense for you to use and why. If you remember, that's one of our decision points. We're also going to look at the completeness of what's the charge-off and recoveries. You probably have spreadsheets and files with this information, but is that in the core? And how do you know that you have them all? And where are the gaps and what do you need to do with them? Looking at some of those loss rate calculations based on historical losses. And we'll continue to look at historical concentrations so we can look at patterns and try to help you decide whether you need to do subpooling or disaggregation or any of that sort of thing. And finally, we're going to identify outliers in the portfolio and see whether or not they fit in any pool and whether or not you want to consider making them individually impaired or part of a disaggregated pool. So next year, we're going to add these features and functions to keep you moving down the journey to CECL. If you continue on, the following year, we're going to move forward to the next level, which is really to look at things like life of loan and actually establishing life of loan and looking at the alternatives, considering the methods by pool and subpool, and then look at some snapshots, maybe get an idea of what the ACL impact is going to be without qualitative factors, just your quantitative. Get some ideas of the different methodologies, how they impact the ACL. Look at some sample disclosures as well. What do the reports look like and what will you be expected to do? And then, finally, let's look at some peer data as we move through to 2022. Will you need it? How will you use it? How do you use it with macroeconomic indicators? And, some of the loss rates based on using peer data and economic. Finally, if you're in the boot camp in 2023, you can decide what you want to do next. You want to upgrade to a full suite. If you're a member of the boot camp, it's an upgrade for the Argus product. Or you can decide to quit the boot camp and take your data out and use it for either another tool set, or if you think you can do it yourself, you'll have the accumulated data and you'll have a lot of this training. So it'll give you some options to begin your parallel runs. That's really the journey. If you join the boot camp, it's an annual subscription fee. And but because you're a CSI bank, your implementation fee is very low because we're directly connected to CSI. And you can quit at any time if you decide that best practices are evolving such that you don't need either the data or the education or the walkthrough over the next couple of years. So just one last thing here to think about. The Ardmore Credit Data Assessment Service. This is an example of the kind of report that we produce where we're looking at, basically key fields, how complete are they, what kind of quality, what kind of consistency. We even look at logical use. So for example, we'll look at collateral codes compared to control codes. Does it make sense? Does it look like people are actually coding properly? What's this, we're seeing real estate in, the wrong categories, things like that. So we kind of help you understand where it looks like you might not be coding in a logical, consistent manner, as well as what fields are you not using. Are you not using NAICS codes for industry? Are you not, risk ratings, is something that I think for some of the smaller institutions isn't being used regularly as hoped. So, for example, we talked about breaking apart subpools. Well, what if basically 99% of your loans are threes? How are you going to break out those pools into credit risk categories if the categories are all the same? So, some things to think about. We would generate a report for you that says, here are the areas for improvement. Here are some ideas for new coding. And we present that report to you through a GoToMeeting, give you a hard copy, but also so if you want to have people there in attendance, like your operations folks, that's fine. We can do that too. And that can be a standalone service or it's integrated into the boot camp if you join. And some of the reporting, just to give you an idea, look like this. We look at data completion, how many records are blank, how many are populated, which ones are important for CECL. And you can use these reports. They come out every month out of the boot camp, so you can see what kind of progress you're making. We also look at things like consistency, month over month, if there are outliers and things like that. So that's pretty much the story of the boot camp. If you're interested in more information, pricing or proposal or statement of work on the boot camp, please contact your CSI RM. They should know who to contact. Brent McCown, who's the loans product manager for NewPoint, is also a good reference, or you can contact me directly. Be happy to show it to you. Thanks a lot for your time this afternoon. We're going to continue these educational webinars as best practices evolve. We think that early next year, we're going to see a great deal of activity. So we will keep in touch with you and bring you up to date. Ardmore always believes that you shouldn't have to do more than you're needed to do. You should meet and hopefully exceed by some degree regulatory expectations. But let's not do work we don't need to do. We got community banks are strapped for resources, strapped for margin. So we're trying to make CECL as painless as possible, and we think the boot camp is the way to go there. So thanks a lot for your time this afternoon. Again, it's Peter Cherpak from Ardmore Banking Advisors. Hopefully look forward to talking to you again soon. Thanks.